Welcome, everyone, to the Real Geek podcast, where we discuss the financial state of the world by providing insight and data. I'm your host, Johnny Garcia, founder and president of the Real Geek Incorporated, which has been helping clients with all their real estate and mortgage needs since 2019. We hope our show provides a little clarity about big issues. After all, it's just math and science. Also, don't forget to subscribe and drop us a like. Now, on to the show. Welcome, everyone, to this week's podcast. I'm Johnny Garcia, your host, The Real Geek, and I got Ron Davison and Dr. Yang here with me. This week, we're going to talk about recessions and depressions, how they affect us, what they are, and why we care. So, first off, hello, guys. How are we doing today?
Doing good. How you doing?
Doing
I'm
well.
feeling a little down given the topic, Johnny.
Well, I just kept hearing all the naysayers and doomsayers online talking about how if it's not crash, now the new hot topic word is a recession. And I'm just kind of like, someone asked me the other day, hey, do you think it's going to be as bad as the Great Depression or the Great Recession? And I'm like, no.
So I have a story to share on this one. So, in 2009, I was in DC and I was at the at one of the economic conferences, and the keynote speaker that day was Christina Romer. She was appointed as the chief economist for the Obama administration, and this was early on in 2009. And I believe her research topic was kind of the Great Depression. And so she's there talking and she's absolutely excited because she gets to apply her research in this real world setting. And so on the one hand, you don't want to, I think my takeaway is you don't want to see economists being really excited because that's when you know that things are bad.
She's like, I've been waiting 80 years to apply this knowledge.
It's like, and if you train all your life studying disasters, it's only natural you're going to be excited because you're applying your research. But you don't want to see excited economists.
Yeah. Well, poor Dr. Fauci, right? He studied infectious disease his entire life, and then he becomes a celebrity overnight. Next thing you know, he's the villain of the world. I'm just kind of like, you're just coming out and stating facts, and now all of a sudden you're vilified. Anyway, that's a whole different conversation for a different day.
So I want to talk about kind of we had this conversation about kind of price levels and what Ron talks about how the housing market is the tip of the spear for the Fed action. And I think the story that I have is, right now lumber prices is now back to where they were. So all the spikes, we're now back to, I believe, like 2019 levels or something along that line. And that, again, it's not going to be everything, but that's in some part attributable to the fact that the Fed basically throttled the entire housing markets. Well, you're not gonna have any flippers, flipping houses and adding a new deck if mortgage rate is at 7% and new housing sales transaction basically cratered, and that's gonna have a very, very direct effect on input prices like lumber, and that's going to percolate down, and that's going to happen to that's going to impact things like wage rates for plumbers and carpenters, and in some ways this is going to affect price levels. Inflation rate's going to go down, because lumber is part of the consumption basket.
Yeah. And as a matter of, well, you know what? And for the people out there, I guess we should also probably start off with what the heck is a recession and how do we define it? I mean, the way, I was taught by Dr. Who, which apparently he's wrong because I just read on whitehouse.gov the proper way, was always 2 consecutive quarters of negative GDP growth, right?
No.
So that is basically from, now I'm reading here from the whitehouse.gov that's basically the back of the envelope kind of way.
Yes.
Gauging what a recession is. But really, there's a group called the National Bureau of Economic Research, and they apparently take a look at what was the significant decline in economic activity that spread across multiple months. Basically, they take a look at real personal income minus government transfers, employment rates, and then real consumer spending versus industrial production, which Yang was just talking about. So what the hell does that mean?
the real short answer is a recession is whatever NBER says it is. They're the official referee of what is and isn't. And so this typical 2 consecutive quarters decline rule, for example, in March of 2020, in March of 2020, NBER right in March says, no, we're in a recession. They didn't wait for 2 quarters of negative decline. And the reason is pretty, and it kind of makes sense, right? If you see an immediate drop of 35% in GDP, you don't need to wait 2 quarters. Like
Well,
even,
yeah, I mean, we
even,
have
even
the
if,
entire world leaders going, hey,
right.
we're shutting everything down. I'm pretty sure it's safe to say, hey, we're going into a
Well,
recession, guys.
conversely, if you look at the 2008 recession, they didn't, the 2000s, I believe NBER didn't say it was a recession until 12 months after it happened. And they said that the official start of the recession is January 2008. And if you look at the GDP data for the first 2 quarters, they were still non-negative. And this is where, again, this is and so yeah, the two negative, it's kind of a rule of thumb, but they're looking at all sorts of things. They're looking at declines in output, they're looking at employment, so on and so forth. And so they're making this judgment call. And so
Interesting. Because I look at this right here, because a gray area, if I remember correctly, means a recession, right?
yes.
So this is between Q1 and Q2, and they're basically saying that it started before Q2,
Well,
but after
Q1,
Q1.
well, Q1 is January, February, right? So obviously the recession, so these are quarterly numbers.
Yeah.
And so if you were to have a monthly number, it probably kind of slowed down a little bit, but it didn't, we don't know to what extent it would have declined. The really big decline just happens to be that March when everything shuts down.
Yeah.
So again, so all these are judgment calls, and so um and so this is where they're, you can say that they're the official arbiter. And they may or may not line up in what we think of as recession. The joke is that, whether it's a recession depends on whether or not you're the one who got laid off.
Fair. And you know what? That's a perfect segue into what I was going to say. The reason I read that description is as I was doing research for this, I looked up all the things that thing was talking about, right? So I looked at, GDP and I'm like, well, according to this, GDP's up. Then I looked at unemployment. I'm like, well, employment finally went up, but only went up 0.2. And I
If
look
you
at
look at
real.
the labor, yeah, if you look at how many people are employed, that was just off a cliff, right?
Yeah.
Yeah. And then
So
real
so
person income excluding current transfers, I'm like, well, this is up too. And then I look, so I'm just sitting here and I'm going, okay, we know inflation is finally starting to level out a little bit, I hope. But, I was just kind of like, okay, well, I know that everyone kept talking about the yield curve inversion, which we'll talk about in a minute, but I guess to you, Yang, I don't know if the NBER couldn't find it if they've actually called it or that we're in a recession yet. But what are your thoughts on based on
so again, I can't speak for
you're
MBER,
not them, yes, I know that, but
but we know that we saw kind of, I believe, two consecutive quarter negative climb, but they're probably looking at things like, okay, what is causing negative climb? Is the negative decline because um they manufacturers are pulling back on inventory? Is that what's driving the decline? They're looking at things like, the labor market and so on and so forth. And they might, a month from now, 12 months from now, they might look at the totality of the data and say, you know what, that is a very shallow recession. But we won't know until that, typically there's a long lag between when it officially happened and when NBR, because it takes a while for them to get the actual data. If you look at data, GDP data takes a quarter for the initial estimate, and then another quarter for revision. And so
because
they're
that's what I was
willing
going
to
to
wait
ask
on
you
that.
here. I'm like, even the 2 consecutive quarters, either I'm looking at the wrong graph or these numbers need to be updated because I don't see it.
Well, no, that's such a wonderful point, Johnny. So there's at least, so inflation and GDP, when they report changes, they use different standards. When they're reporting inflation, they're talking year over year. So price levels 8% up from last year. Price levels 8.2% up from last year. Price levels 7.8. So there's very little change because it's including all 12 months. And it takes a while for prices to start to respond to things that have happened in the last month or two. By contrast, with GDP, they're not looking at year over year by default. You're looking at an annualized rate. So if we assume the changes that occurred this quarter were going to continue for 4 quarters, for a full year, here's what that would mean for GDP. Now, as you'd imagine, that annualized rate where you just say, hey, we had a little bit of a dip. If this keeps up, though, it'll be significant for a year, right? And we had a little bit of a rise, but if this keeps up, it'll be significant for a year. So the GDP, it really, the headline news is what happened for annualized rate. And if you look at, to your point here, if you're just looking at year over year, it's a continued steady with a tiny little dip in the second quarter, right? We had, and to Yang's point, to really say with confidence we have enough data, we can definitively say this is really what happened. That's going to take a couple more quarters, really. But point I'm just trying to make is if you eyeball this, you're going to look at it and go, yeah, GDP's kick along, nice little rate, right? And also, I don't think these are real dollars. This is just billions. So that would be one other little revision to it. But one of the final things, we've had so much reporting on inflation, but if we'd annualized like what happened in the last month, and if that continued for a year, the last 3 months have been like negative to +4, but the year over year is at 8. So inflation right now, as prices are coming down, is actually still getting over-reported in terms of, oh, we got inflation. And the flip side was true the last 2 quarters for GDP. GDP annualized rate, it looked like it fell, and that's what they use. But if you just did year over year, even real GDP had grown each quarter from 4 quarters before, right? It's up for the year over year. So to Yang's point, this is one of the many reasons that ultimately you need a referee to throw down a flag and say that was a foul. That it was a penalty. You really did get in the way of the pass. It wasn't just reasonable defense. And there's judgment calls on all that too, right? As every sports fan will tell you.
Yeah, I think that's one of the big flaws and things that one of the big points I wanted to make is that you got these pundits and these, TikTokers who are just going out and making declarations based off of one of 46 different metrics that that need to come into play. And I remember one thing you told me, Yang, and I loved it because I never forgot it. I'm like, usually we don't know we're in a recession until after it already started because they have to look in the past. So you can never say right now we're in a recession until they analyze the data in the future and look back and go, oh yeah, you were in a recession then.
But well, it's one of the things I love about one of the things I love about the economy is it's like Hogwarts. Like all are the stories about it because nobody experiences the economy, right? Like, the three of us, right? We could be kicking along. I could be going, sales are down a little bit, but I'm all right. And Yang could be like, man, I haven't sold any cars, and I've got no income for the last 4 months. And Johnny, you could be like, I'm signing deals all over the place. I got millions. What's the economy? Well, for three different guys, it's just, one guy might go, it's about what it was last year. Another guy might go, oh man, this is crazy good. And the other guy's going, it's got to be a depression, right? And so there's 330 million Americans. We all have slightly different experiences, and recession is this judgment call about what happened in the aggregate. And of course, there's always individuals who never experience a boom, and some who never experience recession, right? So there's a lot of judgment.
And as an example, I work in the world that that does kind of risk management. And so the world that I'm in, the quants like me, things go well during recessions. They need people to kind of manage risk and calculate risk and quantify risk and quantify losses. So yeah, we, the group, the quants that I represent or, I'm part of aren't very representative of what a quote unquote recession would be.
What you're saying is an economist is a recession-proof career.
So going back to the things you don't want to see happy economists. You don't want to see happy economists. That's when you're in trouble.
Now I'm actually going to start rethinking my life. I'm like, have I ever seen like a moratorium or a mortuary guy happy? Because that'll probably be a bad thing. That'll probably be a precursor for something else. Okay, great. Yeah. So I think we had a pretty good understanding of what a recession is and why we can't necessarily call it.
And I'm gonna throw in one other quick variable here. With Um, so if you go back 200 years ago, capital markets, were something like the Fugers, there were very few bankers who really made a difference for them, right? Interest rates and loans and what was happening with wealth. And the average person's life was just ta da da da. And it was, if anything, it was determined by things like famines and pestilence, right? Well, nowadays, our entire economy is just sitting on this layer of finance, consumer credit, financing for companies, whether or not indexes for stocks are going up, whether interest rates are going down. And so part of what's going on with the whole recession is there's this continual trade-off between people are getting too relentlessly optimistic and prices are too high for things like stocks, crypto, real estate, versus people are getting too relentlessly pessimistic and nobody's going to invest, nobody's going to hire, and we really are going to go into a hole in the ground.
So
And
so
so, with central banks, you're trying to find this balance between this is real growth, it's not just speculative bubble, versus, oh, we're avoiding real recessions. And that's not turning those dials is getting trickier, I think, every generation.
so I think people don't quite think about this as much, but if you look at the data, you can make an argument. Let's just go back to, for example, housing market, right? You can make an argument that in certain instances you have a negative bubble. There's no reason why bubble has to be positive. No, and
Yeah.
so and so and so for something,
Trying to
with
visualize
something
that.
as eh, for something as full of pricing momentum as the housing market, you can have this you can have this buildup of sentiments that hasn't quite that overshoots the fundamentals in the other direction. Now, typically, if you look at the data, typically this negative bubble is nowhere as as deep, but there's no reason why that can't be true. And I think you can make an argument if you look at data, you can see some form of that.
No, yeah, and
You're seeing that now, Yang, is what you're saying?
Not right now, but for
Mm.
example, one measurement of the bubble is the excess premium of housing, this own and rent gradient, right? The idea is that rent, whether you rent or buy, if you do some sort of normalization, the price of paying for mortgage and rent should more or less kind of equal once you factor in everything. And
Mm.
what you see during the bubble time is that people are spending a lot more trying to own a house than the rental prices. It's because that is a very strong indication of people are buying houses not because it makes sense financially, but they're buying houses because they expect a future gain. But you can also, in some instances, you can see the reverse of that in which people aren't buying houses even though the cost of buying something is cheaper, is more affordable than renting. Now, you have to, in this case, you have to factor in things like liquidity, whether or not people are willing to get a loan, whether or not you have enough reserves and so on and so forth. But, I think you can make an argument that in certain cases, you look at data, I think you can see, you do see that.
well, one of the things I think the word you used that really struck to me was sentiment, right? So I remember asking you once, and I think we kind of joked about it, but I loved it when I asked you, "What's the easiest, simplest definition about econometrics?" And I think you were the one that told me, Yang. Forgive me if I mess it up a little bit, but econometrics is just quantifying human behavior, right?
Hmm.
Trying to
Yeah.
calculate so you can try to make decisions
Hmm. Hmm.
and predictions and see what past trends were like.
Hmm.
And because of that, human behavior is so, susceptible to sentiment and opinion and
Hmm. Hmm.
mob mentality is what I call it. That I think the social media aspect of today's day and age has actually affected the economy in a way that we've probably never seen before.
I
What do you
think
think
that's
about
it's
that?
hard. I think there is something. It's hard for me to get a grip on, get a feel of it, but I think there's something to it. But I think it's
I'm
gonna take
just
a
saying, if
while.
people going around thinking there's going to be a crash, the number of people that have told me that like, oh yeah, I don't want to buy right now because housing prices and interest rates are, and we're going to head into another depression or recession. And I'm like, where are you getting that information from?
So so I believe what's his name? The Schiller, Schiller and the case Schiller. That was one thing that he's kind of playing around with. He had published a book a few years ago called Narrative Economics, and in which he's trying to quantify kind of how sentiments impact the economy, and the general book review, the general critique for his book was that there's not enough data. There's like, a lot of this is kind of speculative, or not speculative, but there's not enough data. But I think a reasonable rejoinder to that is, well, it's hard. How
No,
do you how
100%.
do you measure sentiments? Like,
They no, hold on, because they just came out with the how, like they take polls, right? That's what a poll
no. Well, yeah,
sentiment.
yeah, right. But the
But
things that you can measure sentiments, but how
how
good
does
are
it
these
affect
measured?
you?
And so I think these are very real challenges. I mean, in some ways, we are trying to create all these things. We, but these aren't easily constructed. We, again, like, we have tools now like Google Trends and stuff like that, and they're probably um qualitatively, um they're probably reasonable qualitative measurements, but you don't just want qualitative measurements. You want, some sort of precision in it, and I think that's going to be very, very difficult.
The problem,
And
no,
and
Have
I
you
I
ever?
would argue as a data scientist, I would argue that the data exists.
Mhm.
It just can't relate to each other because that would violate so many privacy laws. I
Oh,
couldn't,
yes, 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 yes.
all the
Well, I
data
mean,
is out there.
Yeah, yes, go
the
ahead.
other thing, data is on at best the present, usually the
Mhm.
past.
Yes.
And I don't know if you've ever watched a murmuration of sparrows. There's just phenomenal
Yes, yeah, yeah,
videos,
yes.
right? Like try to predict when they turn. Like maybe not, right? Maybe you can do it.
Well, they
And
they
that's what you're trying to do with markets. And it's, one of the things that absolutely boggled my mind just the other day, because I have these weird thoughts from time to time, but I just thought, what an incredible evolutionary experiment we're in the middle of. You know that there's nearly 8 billion people, every single one of them has free will. Like I go into my wife's kindergarten class, the 5 and 6 year olds, they already have free will, right? And it's just mind blowing that we make a coherent society out of this. And then, an economy, it's this weird dance between what I can supply and what I can demand and what you demand and what you supply, and getting those to fit together, and got too much, too little, right? And trying to get all that synchronized with 8 billion different people. Oh my word.
Ron, you're scaring me because I had the exact same thought not too long ago. Thinking I was reading a book about the Middle Ages, and I'm like, look how jacked up humans made the entire world, and we are like 100 times bigger now than we were then. I mean, we're
Yeah.
like on the cusp of like one bad mob decision of just
so so
destroying
so
everything.
so first of all, Ron, I need you to tell your wife's kids to stop screwing up my econometric forecasts.
I'll talk to him. I'll talk to him.
And secondly, I think I'll have an example. Like, I think example, I have a professor at Irvine that does kind of forecasting things like, okay, well, what makes blockbusters? And
Mm.
and you can make, on the one hand, Netflix is trying to kind of solve that holy grail, right? They have also data, they know what you want to watch. And in theory, they have this econometric mirror says that, you know what, there's a segment of movie that would love to have a period piece, a period drama in the 19th century France, but with people with Australian accents, whatever. Um,
And aliens drop in
right,
the third
right, that
act.
was right with a, but the thing is that, but there's still a lot of just kind of this randomness, right? Like, snakes
Yeah.
on the
There's
plane.
not equal
Why
content,
did,
right?
snakes on the plane, out of like just, all the movie that made it. And again, one tweet that got viral, and that dragged the whole thing along, and there's no way you can forecast something like that.
You know what? That's a perfect segue into this next topic because I keep hearing about the 6 red flags of a recession or whatever.
Hmm.
And the one that keeps being repeated a lot recently, which is the one I wanted to talk about next,
Hmm.
was this inverted yield curve.
Hmm.
Mm.
Yes,
So
yes.
before we jump into it, because most people don't know what it is, and neither did I until I read it. So I'm gonna try to explain it in layman's term of what I think this means, and you guys can correct me when I obviously say it wrong. So treasuries are basically considered the safest financial instrument because it's backed by the U.S. government. So they're always going to, or we assume they're always going to pay, or the trust that they're going to pay is the highest out of any other thing. Okay. Now, so basically, what is a treasury note? you basically, it's a loan. You're giving the government loan on a promise of you're going to get an interest rate back. So in general, the idea when it comes to loans is if you're going to lend the government money, the longer you lend the money to them for, the higher the interest rate you expect to get. So if you let them borrow money for 30 days, you might get a 1% return. But if you let them borrow it for 5 years, you would expect maybe a 3 or 4% return or whatever it is. That's usually the way that it works. Now, what we're looking at here is what they're comparing the 10-year treasury to the 3-month treasury. And basically what this is saying, if I'm correct, is that the yield or the amount of interest or the yield, the amount of money that you're going to get back for a 3-year is actually higher than a 10-year, causing it basically making that the 3-year is like more of a better deal than the 10-year, which tends
It's
to
actually 3 month. Look at that again. It's
year,
minus 3 month. Yeah.
yeah. So
So
basically,
even
lending the
more
money
exaggerated.
to the government for 3 months is going to yield you a better return than letting it borrow it for 10 years, which is counterintuitive for the most part. Did I explain that correctly, Mr. Econ guys?
Yeah. So in a nutshell, to your point, interest rate, one of the many ways to define it is it's a price I pay for risk or uncertainty or deferment, delay of gratification. And the longer I have to absorb that risk or delay my gratification, I gave you $100. I'm going to expect $110 back in 3 years because I didn't get to use my $100 for those 3 years. And if it's 5 years, then I want even more because I couldn't use it for even longer, right? So all those things, yeah. And when you have an inverted yield curve, what you've got is the flip side. It's like, I'm going to give you $100. You pay me back 98 in 3 years, we're good. It's like, wait, what? Right. And so that obviously, refers to things like, in my mind, the way I interpret this, and Yang's probably got better insights, but in a nutshell, people see that the Fed is raising rates, right? But they think that longer term, particularly like out over a 10-year horizon, that'll change. So, you're willing to take a discount against current rates because you can lock in something a little better for 10 years. And this 3 month, you're going to get a higher rate, but you're only going to get it for 3 months. So people, are looking for returns. I've got a whole theory about what's going on in financial markets that I think makes us more prone to recessions, booms and bust. But it's long and it's convoluted, and I'll let Yang elaborate on what you said because he's got insights.
So a quick note this. A lot of this is kind of fundamentals, but I think what happens is that you have this modern infrastructure that probably makes this a self-fulfilling prophecy. Every major companies have a planning, financial planning department. And they probably have something along the line of, hey, if we see inverted yield curve, we need to pull back on our investment. We need to pull back on our hiring, which means that, in some ways it's signaling and it becomes, it becomes a self-fulfilling prophecy. And I'm not saying that this isn't a good indicator, but this is, that's part of how this signal percolates through the economy.
Yeah. So, but again, I think one of the takeaways that I got from this is that although it is an indicator, it's one of several.
Yes. Yeah.
Not a switch.
Yeah. It's not a switch. No.
Yeah. Just because it happened doesn't mean we're in a recession.
No, but it is a very good. It is a very good indicator. It does. I mean, again, it might seem like black magic and stuff like that, but if you look at the historical, it does. It does have a pretty decent track record. It's not it's not written in stone, but you're going that I think think about if you are a large publicly traded company, you see the signal, you're not going to not pay attention to it. And you're going to take, if you're a bank, you're gonna say, okay, well, I know that I'll have more defaults when the economy goes bad, so I'm gonna pull back on lending. And that's a very rational behavior from the perspective of that individual bank.
Yeah, like right here it says it may be better for banks to engage in shorter term lending, potentially making less capital available for the sort of longer term projects.
But there's a whole feedback process here.
Yeah. Yeah, no, absolutely. And I just wanted to kind of point that out so that people understand that there are several indicators. This
Mhm.
one seems to be the one that everyone keeps talking about,
Yes, yeah,
which
yeah.
I thought was interesting only because A, I had no idea what the hell it was measuring. B, I didn't know how it was calculated. And C, I didn't know why it mattered. So that's kind of, now you put it into perspective, and now I don't mind using it as an indicator, but I don't want to use it without knowing why it's an indicator, I guess.
And the way you use it in conversation, Johnny, when somebody's talking about these recessionary situations and long term and short term, you just turn and look at them kind of aghast and you say, that's inverted.
Yeah. I turn upside down and I just kind of go, wait, what? I'm like, you're just looking at it upside down. Flip it over. It's fine. Yeah.
Extra credit if you can. Extra credit if you can work in convexity.
I don't even want to mess with that. Why was I looking at this? Oh no, I just kind of threw this out there. I wanted to see if there was any kind of correlation or causation between, stock market trends and yield curve inversions and what. And so I was kind of playing around with it, and there really isn't any kind of correlation that I mean, smarter guys, I'm sure, have tried doing this, but I don't see although apparently today the stock market closed like 500 down, so, or the Dow did. So I'm sure that has more to do with the midterms than anything else, but
So my my retirement plan just gets constantly downgraded. It goes from Tahiti to Cancun to
well, the good news
to
is, you're
To
still
the
young, so I don't
backyard
think
with
you're
the
to a
going to
lawn
backyard,
chair.
retire
right,
anytime
right,
soon. You got plenty of time to recover.
to a desert island in to a desert island out in New England.
Desert island in New England. Yeah, that sounds not fun at all.
Could be beautiful and green, could be bucolic.
Yeah.
Well, but one of the problems, right, with this modern world, there's this debate that I think is so I'd love to hear you guys' perspective on. So without telling you what school I'm in, one school is we have a glut of capital now. All these aging boomers, there's a ton of capital. Startups don't cost quite as much. 12 guys with a laptop can start a Yahoo and sell it for billions. You don't have to build factories, which are capital intensive, in order to ramp up and sell things. So the one hand got a glut of capital. That tends to mean low interest rates because capital, interest rates just the price of capital. And if there's a big supply of it compared with what the demand is, don't need as much. The other is more focused on the central bankers throughout the world, or
Mhm.
particularly the OECD, the Organization
Yeah,
for
yeah.
Economically Developed Countries. And basically says these guys keep avoiding the reckoning that we should have with asset prices. And they keep trying to raise asset prices by keeping interest rates low, and therefore we keep creating these little bubbles that are getting harder and harder to sustain and require more and more creative kind of monetary policy in order to keep asset prices in full employment. So one hand, we just have too much capital, so it's only natural price falls of capital interest rates, and that changes some things. And on the other hand, you have, it's not really a natural act, it's monetary policy from central bankers, and they keep deferring these bubbles and doing the Houdini trick to get out of them, but it's sort of playing with fire. So anyway,
Isn't that the purpose of the central banks and the Federal Reserve? They were created specifically to wave their magic wands and try to control the craziness that is the markets, no?
yes. And the one caveat on that too, right, is part of normal market. You're always trying to guess the future, and you will always get it wrong a little bit. If you're underestimating the future, then prices continue to go up of assets and you continue to expand. And then if you overestimate the future, you're heading into an adjustment where, oh, you know what? We just kind of have to clear out some bad businesses. We have to lay off some unproductive people. We have to reallocate these assets. And oh, by the way, that's going to be a painful process of bringing them from one industry where their talents aren't needed or the capital's not used and put them into another industry. And that's going to be kind of a period of reconciliation and change, right? So monetary policy, you're exactly right. It's to help even out and save us from hitting a recession we can't get out of, right? Because we just never get out of the liquidity trap that Keynes talked about. But
So
but anyway, there is one purpose of a recession is to just say, these industries, these sectors, these companies, these people, they kind of need to be quote freed from their current employment and put into something else. So central bankers try to keep us out of sustained long-term Great Depressions, bad recessions, but they also need to be careful they don't just go from one bubble to another. So anyway, too much
So
capital or too much monetary policy is my question.
so
Sorry, yeah,
I
go
don't know
ahead.
if I don't know if I can answer this, but I have this one thought that's so if you think about kind of if you think about the big economic driver the last 10, 20, 30 years, it's human capital and not physical capital. And
This is
so
not good.
and so you have, the same, like it takes a lot of money to build an auto factory, $2 billion to build it from scratch. But assuming, but you build more or less the same auto factory, that's comparable to the one that you in 1950. Um, the monumental boost to productivity is building new robots. The new robots take some capital, but it's not going to take as much capital as building this giant factory. And further making that factory even more productive is writing in the right codes, having the
Mm,
and the cost of training. Again, it's not $2 billion. It's sending 10 guys to it's getting 10 guys from MIT, and yeah, that takes a lot of money, but the order of magnitude of training those people is millions, not billions.
Yeah, 5 million
And
to train
so
those guys versus the 500 employees they're replacing
and
annual salary wise.
right. But and so when you talk about this capital, this need for capital, the return, this your at least this demand for capital isn't, hey, I need $2 billion to build a completely new, like think of what Tesla did. They didn't build auto plants from scratch. They took over existing ones. So
mm,
so then they didn't go out to the investors and say, hey, we need 2 billion. We said, no, 100 million, we build and we retrofit the whole thing. But in some ways I feel like this kind of this secular or this kind of exogenous technological development probably drives a little bit of this kind of the pricing of capital. And kind of to Ron's point about, okay, will this be true going forward? And I'll think of a scenario where it doesn't. Let's suppose that the next frontier is space mining.
mm.
All of a sudden you need to build these massive rocket, giant cosmodromes. And all of a sudden the cost of capital goes up
By
because
the
we
way,
know.
there's already several companies that have been founded for that exact purpose.
But
How many companies?
Several.
Oh,
but in this scenario, your return to capital and cost of capital, again, the demand of capital just goes way up, right? Because it's not just I need engineers to fly these rockets to the moon and mine, 100 tons of titanium. You need to just get lots and lots of people to work and create this giant. And so that probably will change, that could potentially change your demand for capital. So again, I don't know.
interesting. Yeah.
So I don't know how much of this really plays into it, but I feel like this kind of the technology change probably affects the demand to some extent.
No, I mean,
Yeah.
they're all great points. I mean, and kind of leads me into our next and final kind of question about, how does recessions and whatnot affect us? And I know Ron's our go-to historian or historical figure over here, not because you're old, but
An
because
historical figure.
not because you're old, but the figure who likes to talk about historical. So excuse me, misspoke. But I was
No,
going
no, it's
through the
good. It's
different
all good.
I was going through the different recessions and depressions over the last 100 years, and the one that jumped out at me was the 1957 Asian flu pandemic recession,
Hmm.
because it was so, I thought, in line with what's going on
Hmm. Hmm.
today,
Hmm.
right?
Hmm.
And here's a description of it. So there was another, pandemic, and of course, it happened so long ago, 50 years, that we already forgot about it. So everyone thinks like, we're in end times because of COVID, and I'm like, this isn't the first time this has happened. You're fine. Anyway, but same thing, right? The entire sickening untold numbers of 1 million people died in 1957. I'm guessing 1 million people is probably a hell of a lot larger of the human population than it is now. And the industry could triggered a global recession that cut U.S. exports by $4 billion. Again, going back to 57, I'm sure that was a huge thing. But not that it was an easy fix, but remember how Ron talked about how
interstate
Yeah,
highway bill.
Eisenhower, I couldn't think of his name.
Yeah.
Eisenhower was able to kickstart the economy again with huge government spending on the highway construction. And as I was going through a lot of these, I see that again, the Fed almost every single time. Again, the economic problems are compounded by the Fed raising interest rates to slow inflation. They're always getting involved. I'm like, well, our mandate is to bring inflation down. But then all of a sudden, the government comes in and goes, okay, yeah, but now that we got it in check, we gotta, jumpstart the economy. Let's go spend some money. And the only entity in this country that I'm aware of that has the pockets deep enough to do that kind of trigger, because no private sector company I can think of can do it, is the U.S. government, right? So, and I just kind of thought there was a lot of similarity with Biden's infrastructure bill that he just passed. And I'm wondering if, we anticipate that being the quote unquote catalyst to kickstart the economy once inflation comes back down. But I just thought, again, but to your point, Ying, historically speaking, we were able to do from the federal government one giant highway construction project that pretty much put millions of people to work and kickstarted the economy. Do we think something like this could happen today with the same effect? Go.
Go ahead, Ron.
Yeah, so the short answer is I think Biden's plan for building out infrastructure, investing in kids, all that, I think it has both short-term and long-term benefits, like I talked about with Eisenhower's interstate bill. And so it's a beautiful thing, right? Because we want and need both those. I would even go a little bit further briefly and say, and I know this makes me kind of pry in some circles, but I still think crypto is just wildly speculative thing. And I honestly think crypto is evidence not that we need more currency, but that we have too much. And as real interest rates go below zero, people are looking for higher and higher risk in order to get, they're looking for higher and higher return and accepting higher and higher risk to get that. What I think works for long term is you have the public sector put investments into things like ARPA, development of touch screens, satellites. And then the private sector comes in and says, what if we combine these technologies to create smartphones? And my goodness, $1 trillion company, no, $3 trillion company. And that dance between the public sector putting money into these things that are really unpredictable and we don't know how long and what will work, and the private sector coming in and going, that cherry is ripe to pick. Let's put that into a product people will pay for. That little dance, right, is one that I think creates enormous amount of wealth. And people who are like, like some liberals are really anti-corporation and some conservatives are very anti-government. I think they're like two legs for a guy trying to move fast. Like you need them both to be strong.
Mm-hmm.
You need the private and the public sector to both be strong, dynamic, investing lots of money and at different horizons. So anyway, Biden, I think his money he wants to put into cancer, the money he's putting in infrastructure, the money he's putting into other kinds of random kind of research stuff from what I've read and funding education more. Those are long-term investments that have a payoff that will enjoy as private citizens. So I'm very bullish on those strategies, those approaches.
History has shown that only the government or the public sector is able to fund a lot of these crazy ideas, right? And people are complaining about how we're throwing money away at researching these crazy things and why do we need to know that? I'm like, I'm pretty sure when we discovered, or we first mapped the genome or we first discovered DNA, there was no practical application. But now we have RNA vaccinations. I mean,
well, when Al Gore imposed spending $600 million in the information highway, like people didn't know what it was. They laughed at him, right? It was like information highway. What is this thing? And at that point, there were like 3 million people maybe who were online. And if you want to hear a story about public sector investment resulting in private sector returns, here's one I think is fascinating. So there's this guy. He is one of the first guys under ARPA, because sometimes it's called DARPA, sometimes it's called ARPA. Anyway, he's one of the first guys on the ARPANET, helped develop it. This was back when maybe 1,000 people were online, and ARPANET, of course, became the internet. And then later, he managed West Coast Research Labs. So Sandia Labs, Lawrence Livermore, like that was all under him. And so here's a guy who knows the internet and he knows how to manage huge teams of technical people developing new things. Anyway, this little kid's born to a single mom, but he has this cool grandpa who he goes spend summers with. And he calls the grandpa his mentor. The little kid is Jeff Bezos, and the grandpa is this guy who was one of the founding guys for ARPANET and one of the first directors. His grandson, becomes the richest guy in the world for years because he manages this huge technical team working on the internet. So, I mean, we're talking about, these aren't even like abstract dominoes falling like one. It's like pow pow. Here's mentoring from a guy who has front row seat of how all this works. And right there, I mean, if you want to say, does public investment in these weird technologies lead to private wealth and jobs? Yeah, 2 million people work at Amazon. Bezos is rich. So I think that might be as simple an illustration as you could find of
I love it
the
because
payoff.
So
I love it
so
because, oh, go ahead. Yang.
regarding Ron's opinion on crypto, I'm gonna reserve judgment until I figure out whether or not Matt Damon got paid in crypto or greenback for his Super Bowl commercial.
Oh,
For the
awesome.
peak advertisement.
Yeah, I think
Well, no. I need to understand whether or not he got paid in,
I think Bitcoin dropped
U.S.
to
dollar,
15K today. So
U.S. dollars or crypto. That will help inform my decision about whether I'm on Ron's camp on this one.
fair enough. But Ron, to your point, I mean, because that's a similar. I mean, one of my favorite is the Silicon Valley story, going back to the, actually didn't even start Silicon Valley, right? Started in MIT, where they have government projects to create these giant, they called them number machines back then. They, I mean, a 5 megabyte hard drive, I think, was as big as like 300 square feet, and it had, it was crazy, right? But you had all these kids who were playing around with these things and trying to figure out what they could do with it. So my favorite story is there were these two kids that grew up in the same neighborhood in Palo Alto, and they would go up and down the street, and it turns out that this entire street was all the engineers from the local labs and lived on the same street, and they would be tinkering in the garages, and these kids would walk by and just ask them, hey, what are you working on? What are you doing? And next thing you know, they're like, oh, Dad, check out what I figured out. And then you get freaking Steve Jobs and Wozniak building the first personal computer. I mean, the Home Club is an incredible group of a bunch of geek punks,
right?
Who just kept saying, screw you, I'm gonna play. And next thing you know, we have,
I mean, they were just obsessed, right? Like this is one of the things that FDR, right, and Vannevar Bush had insights into coming out of World War II, where FDR basically said, we've been spending a ton of money on trying to destroy people with things like atomic bomb research. What if we spent similar sums on trying to make life better? And he put Vannevar Bush on this. He was a guy head of MIT, had started a company. And basically, Vannevar Bush, to your point, Johnny, one of the things I thought was so brilliant in his write-up about what we could do with billions just going into basic research, he was a big believer, as I am, in intrinsic motivation as a guide for what's going to matter. And if you let really smart people try to solve problems that strike them as important and fascinating, this will inevitably lead to breakthroughs. And, that was the beginnings of DARPA, right?
Yeah,
and
well,
so
look at the
our modern
vaccines
world.
for COVID, right? I mean, the amount of money they dumped into RNA research. I mean,
and I think that probably is maybe you two have better concluding things, but I think this is maybe a perfect conclusion. If more money is coming into the economy and it's bidding up the price of existing assets, you will eventually have a bubble because those prices will be too high and prices will come down. If money is coming into the economy and it's creating new assets, new knowledge in particular, new technologies, new industries, new markets, new businesses, that is sustainable. And one of the more influential books I've read in the last few years is David Deutsch, Beginning of Infinity. And it's a really convoluted, at times really fascinating, at other times book. But the punchline, in my opinion, is if we make our progress dependent on knowledge, and knowledge builds on knowledge, and knowledge sparks knowledge, and that builds on more, and so on, we have begun this infinite process of improvement, change, and progress that can continue indefinitely, right?
So I kind of follow up on kind of what you about this power of immersion, especially for kids. And in some ways, the Chinese have known this for a long time. And one of the most kind of enduring story of the Chinese, kind of within the Chinese cultural, kind of this cultural asset of kind of
Legacy.
cultural stories is the story of this very, very kind of celebrated Confucian scholar. And the story is about how when he was a child, his mother, initially lived right next to the butchers, and he saw the kids, mimicking butchers and cutting meat. And so she said, "I gotta move to somewhere else." And she moved right next to a mortuary, and she found a kid, learning, learning how to kind of like play acting, burying the dead and stuff like that. And finally she moved right to a school. And then you think about, this power of immersion and how, again, this kind of the idea of serendipity, that when you put kids, among people who know things, you don't, magic happens. And I think about how, what, in the United States, we have this entire cohort of baby boomers, some with very, very high level of technical knowledge. They're going to retire. And I think that maybe, as a matter of public policies, I would create some sort of program. And you know what? Have like, pay some of these retirees some money, have them run some sort of kind of essentially have them act as kind of additional grandpas. Have them run just kind of like just a room with some food, and the kids can run around and they can ask questions and they can show off like the things that they built. And again, you do that enough times, you're gonna have some magic happen.
Or
I love that.
And last comment here, or we can just have, the government put money into DARPA to create the matrix plug in the back of your head, and then we can just download all the information from the boomers.
I don't so I do feel that I do feel that, for all the technological, at the end of the day, that immersion, that personal immersion, that osmosis, it's the fact that, hey, what are you doing? Hey, check this out. I think there's still a lot to be said about that physical interaction that really leads to learning.
Yeah, I mean, in conclusion, guys, I think one of the things that we've identified here is that recessions, unfortunately, are just, part of the economic cycle. They're inevitable, but we've also shown that they're not nearly always as bad as people make it sound to be. But more importantly, a lot of good things can come out of it, because from everyone that I've researched, usually the government spent a whole bunch of money and good things end up coming out of it.
You have,
And
obviously
yeah,
you want to do it right as best as possible. But yeah, no, there's
yeah.
definitely kind of the basic research that, again, there's no substitute right now.
So yeah, the world isn't going to end. The crash isn't coming, and yes, we're probably headed for a recession, but it's anticipated and it was necessary to deal with the pandemic. But promising future, guys. Thanks again. As always, you guys were awesome. We're gonna go ahead and end it here. I know we have lives, and some of us actually have jobs and work to do. So I'm gonna go ahead and say thank you again, guys, and we will.
Thanks, Johnny. Thanks, Shane. Always fun.
Guys,
Yeah,
have a good one.
Later.
Take care. Bye-bye.
Bye.
Things, and why do we need to know that? I'm pretty sure when we discovered, or we first mapped the genome, or we first discovered DNA, there was no practical application. But now we have RNA vaccinations. I mean,
Well, when Al Gore imposed spending $600 million in the information highway, like people didn't know what it was. They laughed at him, right? It was like, information highway, what is this thing? And at that point, there were like 3 million people maybe who were online. And if you want to hear a story about public sector investment resulting in private sector returns, here's one I think is fascinating. So there's this guy, he is one of the first guys under ARPA, because sometimes it's called DARPA, sometimes it calls ARPA. Anyway, he's one of the first guys on the ARPANET, helped develop it. This was back when maybe 1,000 people were online, and ARPANET, of course, became the internet. And then later, he managed West Coast Research Labs. So Sandia Labs, Lawrence Livermore, like that was all under him. And so here's a guy who knows the internet, and he knows how to manage huge teams of technical people developing new things. Anyway, this little kid's born to a single mom, but he has this cool grandpa who he goes spend summers with. And he calls the grandpa his mentor. The little kid is Jeff Bezos, and the grandpa is this guy who was one of the founding guys for ARPANET and one of the first directors. His grandson, becomes the richest guy in the world for years because he manages this huge technical team working on the internet. So, I mean, we're talking about, these aren't even like abstract dominoes falling like one. It's like pow, pow. Here's mentoring from a guy who has front row seat of how all this works. And right there, I mean, if you want to say, does public investment in these weird technologies lead to private wealth and jobs. Yeah, 2 million people work at Amazon. Bezos is rich. So I think that might be as simple an illustration as you could find of
I love it
the
because
payoff.
So
I love it
so
because, oh, go ahead. Yang.
regarding Ron's opinion on crypto, I'm gonna reserve judgment until I figure out whether or not Matt Damon got paid in crypto or greenback for his Super Bowl commercial.
Oh,
For the
that's awesome.
peak advertisement.
Yeah, I think
Well, no. I need to understand whether or not he got paid in,
I think Bitcoin dropped
U.S.
to
dollar,
50K today. So
U.S. dollars or crypto. That will help inform my decision about what whether I'm on Ron's camp on this one.
fair enough. But Ron, to your point, I mean, because that's a similar. I mean, one of my favorite is the Silicon Valley story, going back to the, actually didn't even start Silicon Valley, right? Started in MIT, where they have government projects to create these giant, they called them number machines back then. Transist. I mean, a 5 megabyte hard drive, I think, was as big as like 300 square feet, and it had, it was crazy, right? But you had all these kids who were playing around with these things and trying to figure out what they could do with it. So my favorite story is there were these two kids that grew up in the same neighborhood in Palo Alto, and they would go up and down the street, and it turns out that this entire street was all the engineers from the local labs and lived on the same street, and they would be tinkering in the garages, and these kids would walk by and just ask them, hey, what are you working on? What are you doing? And next thing you know, they're like, oh, Dad, check out what I figured out. And then you get freaking Steve Jobs and Wozniak
Yep.
building the personal computer. I mean, the
Yep.
Home Club is an incredible group of a bunch of geek punks
Right.
who just kept saying, screw you, I'm gonna play. And next thing you know, we
I
have
mean, they were just obsessed, right? Like this is one of the things that FDR, right, and Vannevar Bush had insights into coming out of World War II, where FDR basically said, we've been spending a ton of money on trying to destroy people with things like atomic bomb research. What if we spent similar sums on trying to make life better? And he put Vannevar Bush on this. He was a guy head of MIT, had started a company. And basically, Vannevar Bush, to your point, Johnny, one of the things I thought was so brilliant in his write-up about what we could do with billions just going into basic research, he was a big believer, as I am, in intrinsic motivation as a guide for what's going to matter. And if you let really smart people try to solve problems that strike them as important and fascinating, this will inevitably lead to breakthroughs. And, that was the beginnings of DARPA, right?
yeah,
And
well, look
so
at the
our modern
vaccines
world.
for COVID, right? I mean, the amount of money they dumped into RNA research. I mean,
And I think that probably is maybe you two have better concluding things, but I think this is maybe a perfect conclusion. If more money is coming into the economy and it's bidding up the price of existing assets, you will eventually have a bubble because those prices will be too high and prices will come down. If money is coming into the economy and it's creating new assets, new knowledge in particular, new technologies, new industries, new markets, new businesses, that is sustainable. And one of the more influential books I've read in the last few years is David Deutsch, Beginning of Infinity. And it's a really convoluted, at times really fascinating, at other times book. But the punchline, in my opinion, is if we make our progress dependent on knowledge, and knowledge builds on knowledge, and knowledge sparks knowledge, and that builds on more, and so on, we have begun this infinite process of improvement, change, and progress that can continue indefinitely, right?
So
And
I kind of follow up on kind of what you about this power of immersion, especially for kids. And in some ways, the Chinese have known this for a long time. And one of the most kind of enduring story of the Chinese, kind of within the Chinese cultural, um, um, kind of this cultural asset of kind of
legacy.
cultural stories, is the story of this very, very kind of celebrated Confucian scholar. And the story is about how when he was a child, his mother, initially lived right next to the butchers, and he saw the kids, mimicking butchers and cutting meat. And so she said, I gotta move to somewhere else. And she moved right next to a mortuary, and she found a kid, learning, learning how to kind of like play acting, burying the dead and stuff like that. And finally she moved right to a school. And then you think about, this power of immersion and how, again, this kind of the idea of serendipity that when you put kids, among people who know things, you don't, magic happens. And I think about how, what, in the United States, we have this entire cohort of baby boomers, some with very, very high level technical knowledge. They're going to retire. And I think that maybe, as a matter of public policies, I used to create some sort of program. And you know what?
Mm.
Have like, pay some of these retirees some money, have them run some sort of kind of essentially have them act as kind of additional grandpas. Have them, run just kind of like just a room with some food, and the kids can run around and they can ask questions and they can show off like the things that they built. And again, you do that enough times, you're gonna have some magic happen.
Or
I love that.
And last comment here, or we can just have, the government put money into DARPA to create the matrix plug in the back of your head, and then we can just download all the information from the boomers.
I don't so I do feel that I do feel that, for all the technological, at the end of the day, that immersion, that personal immersion, that osmosis, it's the fact that, hey, what are you doing? Hey, check this out. I think there's still a lot to be said about that physical interaction
Yeah.
that really leads to learning.
Yeah, I mean, in conclusion, guys, I think one of the things that we've identified here is that recessions, unfortunately, are just, part of the economic cycle. They're inevitable, but we've also shown that they're not nearly always as bad as people make it sound to be. But more importantly, a lot of good things can come out of it, because from everyone that I've researched, usually the government spent a whole bunch of money and good things end up coming out of it.
You have,
And
obviously, obviously
Yeah.
you want to do it right as best as possible. But yeah, no, there's
Yeah.
definitely kind of the basic research that, again, there's no substitute right now.
So yeah, the world isn't going to end. The crash isn't coming, and yes, we're probably headed for a recession, but it's anticipated and it was necessary to deal with the pandemic. But promising future, guys. Thanks again. As always, you guys were awesome. We're gonna go ahead and end it here. I know we have lives, and some of us actually have jobs and work to do. So I'm gonna go ahead and say thank you again, guys, and we will.
Thanks, Johnny. Thanks, Shane. Always fun.
Yeah,
Have a good one.
Later.
Take care. Bye-bye.
Bye.
Well, guys, thank you so much for listening in this week to the Real Geek Podcast. We hope you enjoyed it. If you did, please hit that like button and subscribe so you can stay up to date on any new episodes. This is Johnny Garcia in the Real Geek Podcast studio saying it's just math and science. Once again, thank you for listening, and we'll see you next time.